And we're back. Ernest, Wong, how you doing?
It's finally getting chilly.
We always have to start off with the weather. It is getting chilly, and I gotta start wearing jackets. And do you have do your kids have outgrown all their clothes? Do you have to buy like a new winter jacket, new boots every year?
So my kids are at the age where they no longer want to wear a jacket,
Yeah.
even though it's getting cold, even though they probably will get a cold. But you asked them, do you need to wear a sweater, or do you need to wear a jacket? Nope, I'm good.
I remember the days. So I have two boys. When they were in, I guess, grade school or what have you, when they would go play outside at the recess, they would put on, I think the teacher would make them put on their jackets, but then they would immediately take them off, no matter what the weather was, playing outside, and they would hang their jackets on the fence. And of course, they would come home without a jacket. And so we'd have to drive to the school to go either find the jacket in the lost or found, or see it sitting on the fence. No end to annoying for me, but this is what happens when you have kids who, I guess they're always warm. I guess they're running around and they're full energy.
There's probably a pop psychology podcast that talked about this topic at some point.
Yeah, so we have to find, someone has to come up with jackets that they can't take off, like straight jackets to keep kids warm. But kids
Maybe that's our next business idea.
Yeah, exactly. So a loaded show today, Ernest. But before we get started, I just wanted to give a little plug to a webinar that we're going to be doing on October 29th at 7 p.m. We're going to do a webinar on, the topic is quality investing for the long run. So those that follow and watch our podcast, and you're pretty guaranteed to know exactly what we're going to be talking about, but we're going to share some investing ideas. We're going to talk about where we are right now in the current market cycle, what we're thinking about, the types of the strategy that we use to invest our own money and our clients' money, and I think it will be really enjoyable. So check it out. We're going to plug it on Twitter. We're going to plug it on our website, and it's free to sign up. No commitments, and I hope you'll enjoy. And once it's complete, we'll post it on YouTube under our website, under our long-term investing podcast YouTube site. So just excited for that, and I hope you can join us.
Yep.
Yeah, it's lots of fun. And you're working on a couple stocks that we're going to talk about for the webinar.
Yeah.
It's a big surprise.
Don't think I'm going to reveal it now.
No, we're not going to reveal it now. So Ernest, before we talk, we have some cool topics, but in the news right now is just the remarkable run of Chinese stocks. I think the Chinese stock market, or a number of stocks, went up like 30 or 40% over a very short period of time, maybe even a week, as China announced some stimulus. Arguably, the Chinese stocks have been under pressure for quite a long time. You see names like Alibaba and PDD, and I don't know all the names, of course, we don't follow or own any of the Chinese stocks, but, laggards for a long time. And I would see people say, well, they're very cheap on valuation, and Charlie Munger liked them, and at some point they're going to go up. I mean, I guess every dog has his day, but Ernest, why won't we be chasing any Chinese stocks for our clients' portfolios?
Well, a core part of our investment philosophy has always been we invest in what we know and what we understand. And although my cultural background is a Chinese person, I certainly don't understand China.
Yeah.
I've only visited China a few times. I don't understand the regulatory environment. I don't understand how people do business. I don't understand how the Chinese government influences the capital allocation at these companies.
Yeah.
So I think even though they might look cheap to us, and certainly the PE ratios and those kinds of things.
Yeah, if you look
attractive.
like one metric, like a PE ratio, you'd say, wow, Chinese stocks look very cheap, but that's just one metric.
But we just don't have, at least for me, I just don't have an ability to be able to evaluate the future of these companies. So take Alibaba, for example. Like, I've done a little bit of work on it just to see if there's anything interesting. And there are certainly, the general concerns about China, its reliance on the whole Chinese economy, whether the cash on the balance sheet is real, there's those kinds of things. But then there's also competitive threats. they are losing a lot of market share in their e-commerce business to PDD. And so there's just so many different factors that I don't know the answers to. And that's why we don't want to play that way. We don't want to invest our money that way.
That's right. And even though many can tell us that the US markets are arguably expensive on a PE ratio, just as Chinese stocks are arguably inexpensive on a PE ratio, that doesn't tell you a whole lot. What are the qualities of the companies? What are the fundamentals that are driving growth? What is the opportunities going forward for companies located in North America versus China? What's the Chinese economy going to look like? Can you trust the Chinese government and the Chinese companies? Can you trust the structure that you're buying when you're buying shares in Chinese companies? Can you trust any of the numbers that they report? So it's hard enough, Ernest, to be a good investor in North America, let alone trying to invest outside. The interesting thing is that since 2009, diversifying outside North America, primarily diversifying outside S&P 500 or NASDAQ, has been detrimental to your portfolio. The U.S. Indexes have crushed all other markets. Investing in China, I think it hasn't earned anything in 30 years. But it's not just China. It's really all emerging markets, all other developed markets, even Europe. We've talked about it before.
Even Canada.
Even Canada, yeah. And explain why.
The U.S. is really a remarkable place in terms of the way that the economy is structured to allow for innovation. And that's why all of the, most of the largest technology firms in the world come from the U.S.
Yeah.
You have Apple, you have Microsoft, and NVIDIA, Facebook.
Yeah.
These are all American companies. And as they've grown and extended their reach to the rest of the world, there's nothing like the S&P 500 in anywhere else in any country. If you look at the TSX, we've talked about this many times on previous podcasts. The TSX is banks, is telecoms, is utilities, is oil companies, which may not necessarily be a bad thing.
Yeah.
But they're certainly not Microsoft or Google.
No, the economics of the industry of telcos or pipelines or utilities or energy companies, commodity companies, generally not very good. And when those companies dominate the index, they don't deserve the same types of multiples as companies that are in tech or infotech or consumer staples or healthcare, which is more in the US, which have high returns on capitals and great reinvestment opportunities. And so don't tell me that it's cheap without qualifying and telling me it's cheap. It's got to be cheap for, it's got to be attractively cheap because the fundamentals are mismatched. Not that the fundamentals have to be there when we're buying these businesses. And the little research that we've done, it's hard to grasp why we should swap a lot of our great quality names in North America for emerging market or other developed market investments. All right. Moving on. So we wanted to give you an update to our clients and those listening about a couple of the stocks in our portfolio that we no longer own. These are companies that we have mentioned before, and we've done podcasts on them. Yep. So we're allowed to change our mind. That's investing, right? Even though we do focus on long-term investing. And these were two companies that we had owned for quite a long time. And two companies, completely different businesses, but the reasons for selling them are very similar. So I'll let Ernest get into it.
So we sold them at various points over the last year.
We didn't mention which companies though.
Yeah.
Okay.
The companies are CN Rail and Vail Resorts, which people who follow us on Twitter may have seen that we've sold some of these stocks.
Yes.
The reason that we sold, so first of all, to take a step back, the way we look at stocks is that, yes, we're long-term investors. We want to look past the day-to-day volatility, what's going on in the stock market, the various business fluctuations that happen quarter to quarter. Mm-hmm. But then eventually, I think you always have to be open-minded to thinking that the business that you're owning is not as good of a business as you initially thought.
Or you find something that is even better than the current business that you have.
Exactly. Mm-hmm. And both of those reasons are why we sold these two stocks. So in the case of Vail Resorts, we first got our position in Vail when they bought Whistler
Yes.
in 2017, which we owned at the time. We got some stock, and then we looked at their track record and we thought it's a good business, and we bought more and held it through then.
Whistler was a standalone company on the Toronto Stock Exchange, Whistler Blackcomb. We'd done okay on it. It had a very fat dividend. And then one day, Vail announced it was making the acquisition. And that turned out to be a great home run for our clients. And probably should have never stuck around with Vail going forward.
Well, the investment thesis for Vail was that they had a world-class management team. The CEO of the company had basically transformed the entire ski industry from a weather-dependent business to a model where because people are buying season passes, they're getting most of their revenue regardless of whether there's going to be snow that year.
Yeah.
What ended up happening is that the reality is that the ski industry as a whole is a fairly mature one. People aren't really skiing more than they have for the last 50 years.
Yeah.
And when you have a mature business, there's only so much juice you can squeeze out of this lemon. And, inherently, there's just not a lot of growth in the business. And you could see this playing out because if the weather's good, then they might have a good year, even though most of the revenue was locked up front.
Yeah.
But then if the weather was bad, then as it has been, then they just are not doing very well.
There was two lousy winters in a row. And it wasn't just in North America. Vail owns assets in Australia, and I think two lousy years too in Australia. So maybe it has to do with changing climate, for example. Maybe it has to do with just a bad trend for the past couple of years, and maybe this year will be better. But it is tough to own a company that's very dependent on snow, and there's no snow.
And the reality is, if you have a mature business that is already the leader in what they do, there's not very much the management can do with the business.
Yeah.
And that's what we're seeing with Vail,
where
they have all these crown jewel ski resorts. They have Whistler, they have Vail Mountain, they have the ski resorts in Australia. People still go to them and people like skiing on them, but it is what it is.
Yeah,
they don't have, and there's not much opportunity for them to reinvest in the business. Every acquisition that they do is extremely competitive because it's a very scarce asset, right? Everybody knows what it is. And so they're not going to be able to get this asset for a premium or for a bargain price.
Yes.
Right? And so that's what we eventually realized with Vail. And we decided, even though the stock was probably reasonably valued at where it was, we decided to move on and buy something else.
It's materially lower today, unfortunately, or I guess fortunately. But, it wouldn't surprise me, Ernest, one day that it could be a takeover candidate because the assets are still there. And weather changes, and skiing's not going to zero anytime soon. And so it generates a lot of free cash flow. So I don't think it was a mistake to own Vail, but I think we found a better opportunity for our clients' money. The other investment that we recently sold was...
And CN Rail is fairly similar to Vail in the sense that every year, or even every quarter almost, there is something that happens that impacts the results.
Yeah.
So you think about in 2023, there was a port strike, there was a wildfire, there was extreme cold,
floods,
and there was floods.
Yeah.
And then this year, they had some wildfire issues. There was again another strike.
Yeah.
I don't think they ended up striking.
Multiple strikes.
Yeah,
even if they don't strike, you have to shut down, prepare for the strike, stop orders.
And then the forestry industry is weak. And so the question that a lot of analysts have to CN Rail is, well, what are things going to look like if things were normal?
Yeah.
But then for a company like CN Rail, like Vail, it's never going to be normal. There's always going to be something that happens to the business. And so if you had an operating period where nothing bad happened, that's the best possible situation that could happen.
Yes.
Right. It's like if Vail, every year it snows at all of their resorts, like that's never going to happen. And that's probably the best year that they're ever going to have.
Yeah.
Right. And so that's what we realized with CN Rail, and that especially in the when it looks like the Canadian economy is, maybe slowing down, we'll see what happens.
Yeah.
We decided to move on to something else.
Exactly. I think that's very fair. I mean, one of the things that attracted us to CN Rail was the fact that Canada is such a diverse place. It's very hard to ship goods on trucks and drones, and as a result, CN had a very strong, monopoly or duopoly with CP Rail.
Still true.
Still true. I mean, that hasn't changed. They had a new CEO that came in, and I don't think the capital allocation was as good as what we thought it would be. Buying back a lot of stock with debt, and of course, the stock price has not worked out in the short term. But I wouldn't be surprised, Ernest, to see both Vail and CN Rail be higher in a few years than what we sold them at. I mean, I don't think we own risky, non-profitable companies that will continue to trend lower. And we've made our fair share of mistakes in sales in the past, but we have to move on and focus on the best businesses that we want to own at the current time. So I think that's a good overview of the rationale for the sales of those two companies. I don't think we had a lot of 2024 isn't over yet, but we didn't have that much turnover this year. I think 2 or 3 major positions sold, 2 or 3 major positions purchased, and that's the way we like it. Very low turnover on our portfolio, somewhere around 10% makes us comfortable with our investment approach.
And I think it's important to note that it's not just reacting to like a specific, the stock price or one specific incident that happened with the business. It's observing like the quarter by quarter what is happening, how the company is responding to these things, and seeing if you have somewhere else that may generate better returns going forward.
That's right.
So, for example, like there's a lot of other companies in our portfolio that bad things have happened to them all the time, but
all the time.
We have confidence that the management can pivot successfully and react, and oftentimes it works out.
So we'll try not to buy any weather-related companies going forward, Ernest. So. Speaking about weather, we're sorry to hear the terrible damage from the Hurricane Helene and the U.S., especially North Carolina, and upcoming. People are expecting it to be a pretty nasty hurricane season. Mainly affecting Florida and those kind of southern, southeastern states. So we don't want to own companies that will benefit from weather-related events. It's just like we don't want to buy oil companies to benefit from Middle East conflicts, but once in a while, those things will impact the bottom lines of those companies. We do think that a company called First Service, we do think that there's potential for more volatile weather. And as a result, we do think First Service, what it's been doing to try not to take advantage, but to provide services that will help out people in need has been a smart one. And why don't you talk about First Service's strategies when it comes to hurricane and the terrible weather events?
So the opposite of CN Rail is probably First Service and Copart. These are two companies that generally benefit from bad weather because they're in the business of, First Service, first of all, they're in the business of providing restoration services. They own a business called First Onsite, which is the largest provider of commercial property restoration after catastrophic events.
Yeah.
So after a hurricane, like all these small businesses and all these people who are owning real estate, they're going to call their insurance company and say, I got to fix my roof. I got to,
water damage, mold, what have you. Yeah.
And First Service will come out and fix your property. They've recently made some acquisitions in the roofing space where they're the largest provider of commercial roofing services in Florida. And so I think they're going to see a lot of business coming from this hurricane.
Yeah.
And then secondly is Copart, which is, we've talked about on this podcast before. They run auctions for salvaged vehicles, so cars that are damaged from events. And they have a very, very large business helping insurance companies clear away damaged cars as a result of storms. And I think they don't make money off these cars, but it's a service that they're providing for the insurance company, and they generally do quite well.
Yeah.
With these kinds of things.
Well, it's very interesting. And, we are not weather people. We cannot predict what the weather is going to do. Hard enough trying to predict what the stock market's going to do. But I think it's clear to us that owning companies that can benefit from bad weather may be a more profitable way to invest than owning companies that get hurt by bad weather, like insurance companies or Vail or CN Rail. But, it remains to be seen.
Yeah, our investment thesis in both of these companies is not that there will be bad weather.
No.
It's that these are fundamentally well-run businesses that are where a side benefit is being able to capitalize on these kind of events.
Yeah, and maybe unlike, Vail is not a very capital intensive business, but still they have to spend money on new lifts, new equipment. CN Rail, of course, very capex heavy, whereas a First Service or Copart, very low capex businesses, right? And so something that we've been thinking about a long time is as we build out our portfolios, and the types of companies that tend to do better are companies that don't have as much capital intensity in their businesses and generate higher amounts of free cash flow. And I think First Service and Copart fit the bill. Exciting deal, Ernest, in the energy space for CNQ. I think someone said, one of the analysts said, I've been waiting for this moment all my life for CNQ to make to become a huge owner in the Athabasca oil sands project.
I'm happy for him.
Yeah.
Yeah, it's heartwarming.
Yeah, it's hard. Okay. Yeah. So why don't you talk about why we're so excited about CNQ and why this just proves how smart they are at allocating your capital.
Yesterday, so what you're referring to is that yesterday, Canadian Natural Resources announced that it would be acquiring an additional 20% stake in the Athabasca oil sands project, which was owned previously by Chevron. Mm-hmm. Chevron, for a variety of reasons, they decided that they no longer wanted to be in Canada. And so they are selling all of these assets to Canadian Natural.
Yeah. Are they selling all of their Canadian assets?
I think it's all their Alberta assets.
Yeah, all their Alberta assets.
Yeah.
6.5 billion US,
Yep.
about 8.8 billion Canadian sold to Canadian Natural Resources, CNQ.
And Canadian Natural already owns, they own 70% of the Athabasca oil sands project.
Which they bought from Shell in 2017.
Yes.
Okay.
So they are already very familiar with this property. They already operate it. So they're simply buying out a financial partner. Mm-hmm. And it's done at what I consider to be a very attractive price. And so just a little bit of background on what the Athabasca oil sands project is. It's an oil sand. It's a reserve of oil in northeast Alberta.
Yeah, the Athabasca Basin. Yep.
Mm-hmm. There are two mines there, which today produce about roughly 300,000 barrels of oil per day. And these are gigantic assets. I think they have about just the properties from Athabasca. These two properties have about 7 billion barrels of oil of reserves, which
sounds like a lot.
By comparison, is more than all of Norway and all of Azerbaijan, which are generally which are large oil producing countries.
This one project.
Yes, this one project is bigger than all of Norway or all of Azerbaijan.
Yep.
Right. So these are very large assets. And so what Canadian Natural is doing is that they're essentially buying out, by buying this additional 20%, what they're doing is they're increasing production to themselves without actually increasing production.
Yeah.
Right. And that's exactly what
They're
Canadian,
getting the financial interest in that 20%.
Yeah.
Yeah.
And so this is really good. This is a really good example of what Canadian Natural does best, which is finding ways to increase production in the lowest possible risk. So if you look at Chevron, right, like the reason that they're exiting Canada is that they want to invest in, they bought a company called Hess, which has a large interest in a project in Guyana, right? So that's how oil companies work.
Yeah.
They say, oh, there's oil in Guyana, like I'm going to go to Guyana.
Yeah.
There's oil in Azerbaijan, I'm going to go to Azerbaijan. There's oil in Kuwait, I'm going to go there, right? But that's not what Canadian Natural does, right? Canadian Natural, they say, look, I can buy interest in my own projects that I'm already operating, that already has oil, has zero operating risk, has zero political risk because you're already there. Well,
And long life, how long life is this asset?
well,
Decades.
you can 7 billion barrels of oil at 320,000 barrels a day.
Yeah.
Right. So, Canadian Natural is continually able to find these opportunities to just increase production without actually having to go out and find new sources of oil in places like who knows where, right? And that's what this deal is, and that's why the market reacted positively to it.
And you said they paid a pretty good price for the acquisition, about 5 or 6 times cash flow, which is less than what its stock is trading for, give or take. And this is an asset that has very low break evens, right? About $40 a barrel of oil.
Low 40s WTI.
Yeah. So unless the world economy collapses, and oil's been hanging around $70 to $80 a barrel for quite a while now. It should generate an enormous amount of free cash flow over the long term. So as a result of this acquisition, Ernest, Canadian Natural Resources has said that it will take on debt. So its balance sheet will worsen a little bit, short-term pain for long-term gain, right? It's raised its dividend. We'll talk about the dividend in a second, but should shareholders have any concerns about the amount of debt Canadian Natural Resources is taking on, or that there'll be fewer share buybacks or dividend increases as a result of this acquisition?
So before we get into that,
Yeah,
I want to talk a little bit about the valuation of 4 to 5 times cash flow,
okay,
or 5 to 6
5 to
times.
6,
5 to 6 times cash flow, depending on where oil prices are. Is that this is not like a regular acquisition of a conventional oil, because the key thing about the oil sands is that they don't deplete. Where, like, if you're taking out oil this year, like, you can take out the same amount of oil next year at the same production cost. Whereas a traditional oil well, like, it gets less productive over time. And so this makes the acquisition extremely attractive, because essentially half of what Canadian Natural is buying is this asset that they can mine into perpetuity. Right. Whereas if they were, again, like buying in shale in the US, for example, these are wells that they deplete extremely quickly, and they would have to go out and find oil again.
6-7 years, it's gone. So you really have to pray that oil prices stay high, and there's no trouble with the wells that you're running. Whereas Canadian Natural Resources has so much experience with the current asset.
And more importantly, I think, is that it allows Canadian Natural to double down on the bet of Canada, the Canadian oil sands, as a future. Because the Athabasca Oil Sands currently has 2 operating mines, but there is a third project called Pierre River, which was approved by the regulator, but Shell never went forward with it because oil prices were low at the time, and they had no ability to move it anyways. But Canadian Natural today, they own 90% of Pierre River as well. They think that Pierre River could be 250,000 barrels per day of production, which would be converted to high quality synthetic crude oil at their Horizon facility. Obviously dependent on the ability to complete pipelines and those kinds of things. But there is a tremendous amount of embedded upside for Canadian Natural at their oil sands operation. And I think probably there will be depending on what happens with the pipelines, there's a lot of ability for them to grow production into the future without having to find more oil.
Yeah. And in the meantime, you and I and the investment team at Baskin think that Canadian natural resources should be valued more like a royalty, right? If you look at royalty stream companies, they trade at 20 times cash flow, whereas Canadian natural resources, maybe whether you use debt adjusted cash flow or regular cash flow, it's well less than 20 times cash flow. And why I'm saying this is a royalty, you buy an interest in an asset that will produce gold or copper or oil for a very long period of time. We just mentioned how much reserves there are in this Athabasca oil sands project, as well as the reserves in the Pierre project, as well as the current production from Canadian Natural Resources on other long life oil assets. So we think at some point the market will recognize this. But I guess the counterpoint, Ernest, I know we're going on a lot of topics, tangents here, but the counterpoint is, okay, you don't have the infrastructure. What about the pollution? And what about the fact that here's another American company, Chevron, leaving Canada? So it's stranded assets. And no one cares about it. What's your comment back to that?
I think I think that's why things like the Pathways Alliance, which I don't remember if we've ever talked about this, but the ability of the oil industry in Alberta to be able to complete projects like carbon capture, like these kinds of things that allow them to reduce emissions, I think they're very important because to the extent that Canadian Natural is able to reduce its emissions, right? I don't know if the perception of oil sands being dirty will ever change, but that will ultimately be what allows them to increase production into the future. Because the more that they lower emissions, the more they can produce and the more that they can sell into the world as clean oil. And I think that will be the key catalyst in the long term that will drive production growth at Canadian Natural.
I do think over time that we will see more infrastructure built to get our gigantic oil assets in Canada out to countries that need it the most. And we've seen a couple projects in production, a couple projects in the development stage, and I think the economics are going to be there for all the companies, and they definitely support it. And a lot of countries do want it, and of course the energy security, right? For now, Canada is a very secure, safe place with a lot of oil reserves and a very accommodating country and capitalist society. So it could be very positive for Canadian Natural Resources over a very long period of time. Okay, so we talked about that. Moving on to, I don't think you answered any of my questions.
Yeah. I think you noted that they raised their dividend.
Yeah.
This is the 25th year in a row. And as a side note, for those who are like interested in this kind of stuff, that makes it a dividend aristocrat.
A dividend aristocrat, 25 years in a row. It's just unbelievable for a commodity producer to have a 25-year dividend growth, and the reinvestment of those cash flows from the beginning stages of the oil sands. I remember, Ernest, well before you got into this business, that in 2006 and 2007, so many analysts who covered Suncor and Canadian Natural Resources, and there's a few other oil sands companies that now have since merged into Suncor and CNQ, said that there's this wall of free cash flow coming, and it just never came. But the last 4 or 5 years, with stronger oil prices, with lower break-evens, that wall of free cash flow is there. And as a result, even though oil prices are up and down like a toilet seat, Canadian Natural Resources has been able to raise its dividend 25 years in a row. It's almost like a utility. Better than a utility because way better balance sheet and many fewer regulations, right? So it's been a tremendous investment for those who are looking for growth as well as dividend growth.
Well said.
Okay. So anything else you want to cover there? Yeah.
I think that to your point about the valuation, as we look at our portfolio, right? Like while we love the Visas and the Microsofts and the Coparts and those kinds of companies, right? There is not much that is generating the amount of free cash flow that Canadian Natural does available at the valuation that Canadian is.
Yeah.
Especially given their track record of doing smart things with their cash flow, right? And so I think we are very happy to continue owning the stock.
Absolutely. And of course, for those that know and understand Canadian Natural Resources, it considers its free cash flow the number after paying out dividends. Yep. Whereas most companies will say, okay, we generated $1 billion in free cash flow. That's before they pay out dividends. Whereas Canadian Natural Resources says we had $1 billion in free cash flow. That's after paying out the dividends. So it's just a signal from management that the dividend is the most important thing. And it's part of their capital expenditure, so to speak, right? It's a weird mindset, but it definitely works because they raised the dividend 25 years in a row. And what's the yield now? It's about just over 5%, give or take.
Yes, less now.
Yeah,
but they also do pay special dividends from time to time, and they do share repurchases. Although I think they have said that following this deal, they'll probably repay a little bit of debt before resuming those kinds of things.
And I think, I do understand some short-term investors will say, well, they just got to their debt target of $10 billion. Now they're going to have $18 billion of debt. And they said once they got to $10 billion of debt, all the free cash flow was going back to shareholders as either more dividends, buybacks, or special dividends. Now, of course, that because of the acquisition, they're going to have to pay back a lot of that debt, or they want to. They don't want to keep a large amount of debt on the balance sheet, but we think over time, this will be much more rewarding than Canadian Natural paying out 100% of its free cash flow today, right? Buying the asset will be much more rewarding. And we always say here, I want to reiterate the point, is dividends are great. But it's better to reinvest those free cash flows at higher rates. If Canadian Natural Resources, if that acquisition produces 20% returns on its money, you would rather them invest that money for you than returning it to you in buybacks or dividends in the short term.
Yeah, you can kind of even view this acquisition as a share repurchase of its Athabasca Oil Sands project at a cheaper valuation than what its current stock price is, right? And I think, one of the reasons is because I think the market generally recognizes that Canadian Natural is a good operator. They have good capital allocation, and that by them owning this asset instead of Chevron, they're going to be able to do good things with it.
And here's an example why Canadian Natural is such a good operator. When they bought this project in 2017, the barrels of oil producing were 30% lower than today. So when CNQ bought the ownership stake in 2017, it's increased production by 30%, and it's cut costs dramatically. So they're better operators. If you speak to anybody that does work with Canadian Natural Resources in Alberta or wherever, they are maniacal about keeping costs low because they want you as a shareholder to benefit from their growth and all the things that they're doing.
Yeah.
Anything else you need to add there?
I wouldn't say so.
All right. Well, we really appreciate all the subscribers, all the listens on Spotify and YouTube. Please subscribe to this podcast. And we appreciate you very much, and we hope to see you on October 29th at 7 p.m. And details will be linked in the show notes. Thank you so much for joining us, and we'll see you back here real soon.